What if the next oil crisis crashes the global economy, but sends Bitcoin to the moon? It sounds crazy, but right now, this week, oil just hit $119 a barrel. The stock market is hemorrhaging, and Bitcoin is quietly holding its ground above $70,000, while everything else burns. So, is Bitcoin the escape hatch the world has been waiting for? Or is it just the last domino to fall? Stay with me, because by the end of this video, you'll know exactly what's happening, why it matters, and what the world's smartest investors are betting on right now. Let's set the scene, because what's happening right now is not a drill. The Strait of Hormuz, a narrow waterway in the Persian Gulf, has effectively been shut down. Military conflict between the US, Israel, and Iran has forced the closure of one of the most critical shipping lanes on the planet. An Iranian drone strike forced Saudi Aramco to shut its Ras Tanura refinery. Oil output in Iraq has fallen sharply. Kuwait has reduced its shipments to global buyers. Why does that matter to you, sitting at home watching YouTube? Because the Strait of Hormuz carries roughly 1/5 of all global oil supply. 1/5 gone overnight. Brent crude spiked past $119 a barrel as Iran's conflict with the US and Israel disrupted 20% of global oil supply, a disruption that surpassed even the Suez Crisis of 1956. And the financial markets? They panicked instantly. The S&P 500 closed at its lowest level of 2026. The VIX, Wall Street's fear gauge, shot up to a one-year high of 35. Japan's Nikkei dropped more than 6%. South Korea's Kospi tumbled nearly 8%. This is a real crisis, not a simulation, not a prediction. It's happening right now. And in the middle of all of it, investors are asking the same question. Where do I put my money to survive this? That's exactly what we're going to answer. But first, you need to understand why oil is so powerful it can shake the entire world economy with a single disruption. Okay, let's keep this simple. Think of oil as the blood of the global economy. Every single thing you buy, your food, your clothes, your phone, the electricity keeping your lights on, required oil somewhere in the process. Oil powers the trucks that move goods. It heats factories. It makes plastics. It fuels airplanes. So when the price of oil spikes, the cost of producing everything goes up. And when the cost of producing everything goes up, you know what happens? Prices rise. That's called inflation. Now, here's where it gets interesting for investors. When inflation rises, the Federal Reserve, the central bank of the United States, faces a nightmare. The Fed has what economists call a dual mandate: keep inflation low and keep unemployment low. When an oil shock sends prices soaring, the Fed gets trapped between two terrible choices: raise interest rates to fight inflation and risk crushing the economy, or hold rates and let inflation run wild. Why do interest rates matter to you as an investor? Let me give you the simplest analogy possible. Imagine the economy is a swimming pool. Interest rates are the drain. When rates go up, money gets sucked out of risky assets, stocks, real estate, crypto, and gets parked in safe, yield-paying bonds. When rates go down, money floods back in and prices go up. Right now, the fear of stagflation, rising inflation paired with a shrinking economy, has moved from a theoretical risk to a tangible reality. A dismal jobs report showed a loss of 92,000 jobs against expectations of a 50,000 gain at exactly the moment oil is surging. That's the worst of both worlds. Prices going up, jobs disappearing. The Fed with no good move available. As the conflict escalated, the dollar index jumped nearly 1%, and US Treasury yields moved higher as investors fled risk assets, including cryptocurrencies, reflecting expectations that central banks may face renewed inflation pressure. So oil shocks travel through a chain reaction: supply disruption, higher oil price, higher inflation, higher interest rates, lower stock prices, lower crypto prices. That's the normal chain. And for most of history, crypto has followed it. But something different may be happening this time. And that brings us to the most important question of this whole video. You've probably heard Bitcoin called digital gold. But what does that actually mean? And does it hold up in the real world? Here's the simple explanation. Gold has been used as a store of value for 5,000 years. When governments print too much money, gold holds its value because you can't print more of it. There's only so much gold in the ground. When governments print too much money, gold holds its value because you can't print more of it. There's only so much gold in the ground. When currencies collapse, gold survives. When empires fall, gold is still gold. Bitcoin was designed with the same idea in mind, but for the digital age, there will only ever be 21 million Bitcoin. Ever. Nobody can print more. No government controls it. No central bank can devalue it. Bitcoin was born from the last financial crisis, promising a hedge against exactly this kind of turmoil: inflation, currency debasement, and a loss of faith in traditional finance. That's the pitch. But now, let's look at what Bitcoin has actually done, because the history is complicated. During the 22,000 inflation spike, when CPI hit 9.1% and the Fed raised rates aggressively, Bitcoin should have been the perfect hedge. Instead, it fell 77% from its November 2021 high of $69,000 to under $16,000 by November 2022. Gold, by comparison, held steady and then climbed. So if Bitcoin was supposed to protect you from inflation, it didn't. Not in 2022. Fast forward to today. Bitcoin dropped from its October 2025 all-time high of $126,000 to roughly $67,000 by early March 2026. A 47% decline that accelerated alongside tech stocks when Trump raised global tariffs to 15% in February. Meanwhile, actual gold surged to fresh records above $5,280. Bitcoin has slowly evolved into a quasi-US risk asset, increasingly moving in step with Wall Street, tech stocks, and even the US dollar. This trend has accelerated since the debut of US spot ETFs, which made it easier for institutional investors to access Bitcoin directly. But, and this is critical, something new happened this week that's changing the conversation entirely. On one of the most volatile days of the crisis, Bitcoin climbed 3.73%, opening at $65,970 and rallying all the way to a high of $69,543, outperforming the S&P 500 and the largest stock markets across Asia. And gold, even gold, saw a red day as investors fled to the US dollar. Analysts at QCP Capital noted that while Bitcoin may not have fully earned its digital gold label yet, its role as a digital escape hatch is becoming increasingly relevant, particularly for capital in the Gulf region, navigating geopolitical and financial uncertainty. So what's really going on? Let's get into the debate, because two of the world's top analysts are on completely opposite sides of this right now. There are two camps right now, and they couldn't disagree more. The bull case: why Bitcoin could win this crisis. Arthur Hayes, co-founder of BitMEX and one of the most influential voices in crypto, argues that the chaos in oil markets will eventually force the Federal Reserve to print money. And then the money printing will begin in some way, shape, or form, which benefits Bitcoin, Hayes told Benzinga. He remains firm on his long-term targets, projecting Bitcoin could reach $250,000 in 2026 and up to $750,000 by 2027. Here's the logic in plain English. War is expensive. The US is engaged militarily in the Middle East. That costs hundreds of billions of dollars. The government doesn't have that money sitting around, so they borrow it, or they print it. When money is printed, the value of every dollar goes down. And when the value of dollars goes down, hard assets, gold, oil, Bitcoin, go up. Hayes points to historical precedents. During the Gulf War in 1990, the Fed cut rates as uncertainty weighed on the economy. After September 11, 2001, Alan Greenspan announced an emergency 50 basis point rate cut. Hayes' argument is that the secondary effect, the central bank response, is what ultimately launches Bitcoin. There's another bull argument that's fascinating. Historical data shows oil price peaks often coincide with crypto market bottoms. October 2018, oil peaked while crypto bottomed at $100 billion before surging. June 2022, oil peaked as crypto bottomed near $800 billion before recovering. March 2026, oil at $113 per barrel. while crypto sits at $2.25 trillion. The pattern is repeating. And there's one more piece. NYDIG research shows 75% of Bitcoin's price movement is driven by independent crypto factors, not equity market correlations. That provides a structural floor that traditional markets cannot control. The bear case, why Bitcoin could get crushed. Now the other side, and this side has real ammunition too. Bloomberg Intelligence's senior commodity strategist Mike McGlone warns bluntly, oil volatility will spill into stocks and crush crypto. McGlone views Bitcoin as a bear market asset that is currently vulnerable, arguing that Bitcoin's success is closely tied to the Nasdaq, and when the Nasdaq suffers, Bitcoin follows. Even Arthur Hayes himself, the biggest Bitcoin bull on the planet, said recently he wouldn't bet a single dollar on Bitcoin at current levels. He's waiting for the Federal Reserve to pivot toward quantitative easing before making his move. Hayes' cautious stance represents a dramatic shift from his previous predictions of Bitcoin reaching $200,000 by early 2026. Veteran strategist Ed Yardeni has listed the probability of a U.S. stock market crash this year to 35%, up from 20% previously. He assigns just a 5% chance to a strong crypto bull run, reflecting mounting caution as energy prices spike. Exchange-traded funds now represent approximately 10% of the total crypto market capitalization, while digital asset treasury companies hold significant positions. And these institutional holders face potential liquidation pressures during bear market conditions, creating additional downside risks. So you have the world's biggest Bitcoin bull saying, wait, and skeptics saying, it's going down. Who's right? That depends entirely on which of three scenarios plays out. Scenario 1. The crisis deepens. Bitcoin falls. Bitcoin fell more than 3.5% to below $67,000 in early March, as escalating tensions in the Middle East drove investors out of risk assets and into the US dollar. Stock market watch. If the conflict in the Strait of Hormuz escalates further, oil pushes past $130, and the global economy tips toward recession, this pattern repeats. Institutions sell everything risky to raise cash. Bitcoin falls towards $60,000, maybe lower. This is the scenario where Bitcoin proves the bears right. It's a risk asset, not a safe haven, and it gets crushed alongside stocks. Scenario 2. Oil stays high, Bitcoin rises as the inflation hedge. This is Hayes' thesis. Oil stays elevated, inflation becomes entrenched. The Fed panics and starts printing money to fund war spending and bail out a strained economy. Every dollar printed dilutes the ones already in circulation. And suddenly, Bitcoin's fixed supply of 21 million coins becomes the most important feature in global finance. Institutional money rotates from cash to hard assets. Bitcoin surges past $100,000 and ultimately tests $250,000. The inflation that destroyed it in 2000 becomes the very force that legitimizes it in 2006. Scenario 3. Decoupling, Bitcoin becomes the new safe haven. This is the most dramatic scenario, and there's real evidence it's already beginning. Bitcoin climbed above $71,500 as easing concerns about a potential oil supply shock improved risk sentiment, showing signs of decoupling from software and tech stocks, holding up better than equities during recent macro turbulence. One analyst called it a cautiously optimistic sign. Charles Schwab, the 2026 decoupling may represent market maturation, not market failure. Each asset is finding its distinct purpose. Gold for short-term wealth preservation, Bitcoin for long-term financial infrastructure. When oil prices normalize and liquidity conditions improve, Bitcoin's position as emerging financial infrastructure could attract renewed institutional interest, setting up its next growth phase. In this scenario, Bitcoin doesn't just survive the oil crisis. It graduates. It stops being treated like a tech stock and starts being treated like what it was always designed to be, a borderless, censorship-resistant, inflation-proof store of value. Here's what we know for certain. Oil is the most powerful economic force on the planet. When it moves, everything moves. Inflation, interest rates, stocks, and yes, crypto. That's not going to change. What is changing is Bitcoin's relationship with the rest of the world. The growing presence of institutional investors, large asset managers holding Bitcoin through spot ETFs and direct positions, has brought deeper liquidity and greater integration between crypto and traditional finance. When institutional money begins viewing Bitcoin as a macro hedge, demand can increase significantly during uncertain periods. Bitcoin has failed the safe haven test before. In 2022, it failed spectacularly. But this week, right now, it's starting to behave differently. Bitcoin's own volatility gauge skyrocketed to 88.54 in early February, when it hit a low of $60,000, but has since cooled to 58.02, hinting that Bitcoin's peak panic phase may already be behind us, even as traditional finance volatility is just beginning. And here's the question I want to leave you with. The one that every serious investor, hedge fund manager, and central bank is quietly asking right now. Will the next oil crisis destroy crypto, or finally prove that Bitcoin was built for exactly this moment? The answer isn't written yet. It's being written right now. In every trade, every policy decision, every barrel of oil that can't get through the Strait of Hormuz. What do you think? Drop it in the comments. Is Bitcoin the escape hatch or the last domino to fall? I read every single response. If this gave you a clearer picture of what's happening in markets right now, hit like. It genuinely helps get this content to more people. Subscribe if you haven't, because this is the kind of real-time financial storytelling we do every single week. See you in the next one.